Hi, this is Liqian Ren, Director of Modern Alpha Wisdom Tree ETFs. Welcome to China of Tomorrow podcast series, where we navigate China, India, Japan, and the broader emerging markets with members of Wisdom Tree and other industry leaders. We have founder and Chief Investment Officer Jason Xu of Rayliant Global Advisors, portfolio manager of several ETFs focused on China, emerging market, and developed markets. And Jason is also chief economist at East West Bank. Jason wrote really the original and most popular academic paper on factor investing in Chinese Asians, the good, the bad, and the ugly. So he has, really people who has done research in China factors know about Jason and his great paper. We'll go straight to questions, Jason. Very interesting. Tell us a little bit. You have an emerging market strategy. Like, tell us about how you are thinking about emerging market right now.
Hi, Liqian. So yes, we do have an emerging market ETF. And it actually is emerging markets ex-China, because we also have a China ETF. So, having the two components, right? Emerging market ex-China and China allows you to piece that together to create the full EM. And it gives you the flexibility, right? You don't have to depend on your manager to give you a China overweight or underweight. With the two components, you now, as a financial advisor, have the flexibility of saying, hey, I'm really concerned about China. A lot of people saying it's uninvestable. So maybe, China in this combination takes on a much smaller weight than the benchmark weight that you might find in MSCI EM. Or you're contrarian, right? Hey, when everyone's really afraid I'm going to do more China, you might actually have a big overweight. So it gives you that flexibility. And this is how we do EM, right? We do the two key components to reconstruct it the way you like.
Thank you. And for most of listeners probably know that we at Wisdom Tree, we also have several strategies that exclude China, quality dividend strategy and ex-state owner strategy. But we also have a more active strategy, the multi-factor strategy, which we have like half of the China way, because some people, they want to lower China weight, but also didn't want to be completely out of it. So it's a kind of a one-packed way I think this idea of excluding China from emerging market, it was a couple of years ago, this was still very much on the margin. I think even though I obviously originated from China, and I have at that time even, internally and, talk to clients and colleagues, and I feel like no matter what happens to China, people are likely to look at China differently from the rest of emerging markets. So I think now, with more of these strategies available, and also you have been very, tireless in talking about how to invest in China and outside China. The idea, I think, is really catching on. When you on China, when you're looking at, you are early proponent of Chinese A-shares, and your China product was A-shares only. Even though when I, take a look at the largest 500 Chinese companies, about, I think 40%, depends on how, depends on the day, is about Chinese A-shares, actually, I think about 40% is not Chinese shares. About 60% is Chinese shares. Those 40% is mostly listed in the US and Hong Kong. For us, we have a kind of a mixed approach again, having about, 33 China shares, which is higher than MSCI China index, but not going as much as you are. So actually in the last few years, if you look at the performance wise, A-shares has done better than the non-A-shares Chinese equity. What makes you, so you were, really proven right in the last couple of years that, but still, given it's now, what makes you believe like right now is to go aggressive for Chinese A-shares? For the people who don't know, many of the Chinese stocks tends to be listed, like for example, like Baidu, they listed in the US, or like Alibaba, they have dual listings in the US and in Hong Kong. And a lot of companies also have dual listings between Hong Kong and mainland. So are you still sticking with this heavy China Asia's approach? And what's your general rationale?
Yeah. So, Liqian, there are a number of reasons why, our product is dominated by China A shares. So, obviously before we launch a product, we spoke with a lot of advisors, and, most advisors, they do understand China's big and they have to have some allocation. And actually, many of them have sort of taken out a China allocation, either directly buying Baba because that was just such an iconic company, and then you can buy that in the US directly. Um, or they got some kind of passive exposure that is more really indexed to the original MSCI China. And of course, earlier days, because of access issues, MSCI China really is mostly dominated by shares that are listed in the US. And so what that means is you're mostly accessing the biggest tech companies, and that's it. And in some ways, those tech companies are actually, from a valuation perspective, from almost a code movement perspective, highly correlated with our NASDAQ. So when we say, like, what are advisors missing? We realize they're least comfortable, have the least amount of information, um, kind of a lot of the names that are sort of, consumer, manufacturing, really the other, nine industries that are not, internet technology. You find them only listed onshore in terms of A shares, and those actually generally trade at a much cheaper valuation level. They have a lot more volatility because of its, sort of the retail sentiment, retail dominated, so a lot more alpha production opportunity. So we thought the best service we could provide to financial advisors is really to give them something that they usually can't access easily. Now, our ETF is active, right? I mean, in some ways, ETF is just a chassis for us. So we could have launched an active mutual fund. We just thought ETF is the chassis of the future. And at least for markets like China, like, broader emerging markets, active probably makes sense for most advisors who think about market inefficiencies and ability to extract alpha. So because we're providing something active, right? Really, where there's the greatest alpha and where it's the greatest value and service to the financial advisors is kind of the harder to understand, harder to gather information, and probably harder to evaluate and access, kind of the onshore A shares. So part of it is really from the, service and value to advisors. But there's one other aspect, right? At the time, we did think, like, from a beta perspective, the onshore shares was going to be a better beta, right? So not even talking about the active alpha you could create. And the reason we thought the A shares were going to be a better beta, it's really two. One is usually, A shares can trade at a bigger discount versus the so the U.S. listed shares, just because, the U.S. market, given its liquidity, generally given the high valuation of the U.S., right? If you take a Chinese company, you list it in the U.S., it actually just automatically gets a higher valuation, more expensive, so harder to generate future return. So the onshore were, generally systematically cheaper. We thought, hey, if you're going to buy exposure to China, you want to buy it cheaply, right? Not buy it, in an expensive way. But the other part was a lot of the, offshore listed shares at the time used what's called a VIE structure. And that, of course, is
Yes.
highly, it's been controversial, right? The SEC doesn't love it. The Chinese regulators doesn't love it. Essentially, right? It's like taking Alibaba, but really accessing its Cayman shell. And then the Cayman shell tried to repatriate cash flow of Alibaba from China through complicated licensing. There's not actual ownership relationship. And so there's just some risk, right? If that ever gets challenged, do you actually own Alibaba when it's just a Cayman shell with some kind of, marketing IP, right? That is licensing to the actual Alibaba that owns all, the actual cash flow in the business. So we were concerned just from a VIE structure perspective that risk could blow up, and it did become an issue, right, for a lot of U.S. listed ADRs because of the VIE structure. And so
Yeah,
really,
I think for that issue, I think we definitely have a lot of client concerns. I think on the other hand, I do think in the future this structure likely will evolve. China finally, but you were right. I think China issues, and that is why, and for us, we also have taken on heavier China issues than MSCI China, because we do believe that to access to Chinese broad market, you really need to have maybe not as radical as 100% like you guys are, but definitely need to have some China issues, mainly because, again, under the current geopolitical environment, uh, domestic market is now becoming even more important for Chinese companies. So,
Yeah,
and most of the Chinese companies that have the domestic market share are listed in China issues. And in terms of ETF, I definitely agree. My own career is essentially we believe in ETF structure. That's why 5 years ago I joined WisdomTree, which is a pure ETF platform. And even in China, actually, for people who pay attention to China in the last couple of weeks, China definitely has used some money from the sovereign structures, whether it's based in Hong Kong, everybody's speculating, but I think the Chinese sovereign money in Hong Kong has bought a significant ETFs, China Asia ETFs. That's why Asia has performed really well in the
yeah,
last
yeah. I mean,
couple.
and
Yeah.
legit, right? I mean, that's actually an interesting point you just brought up, right? And you know, you love it, you hate it, but it's just a reality, right? Like if you're invested in emerging markets, especially in emerging Asia, and just take China as an example, you're going to regularly get government support of the market. Like government will come in and buy if they feel like the market's too fragile, if they feel like confidence is why the valuation is poor, right? But for whatever reason, and you can agree or disagree with the logic, but it is just a reality. But when the Chinese government is pouring in, billions and billions to buy shares to support the market, they're not going to buy US ADRs, right? They're not going to Hong Kong.
No.
They're buying domestic listed shares because that's what dominates kind of the local index, and it's the headline that kind of really drives sentiment. So you can benefit extra from that if you're more sort of
It,
domestic shares focused.
Definitely. I think, again, it's something which a lot of people who not familiar with China did not realize, in the sense that China does interfere in the market, but not as much as this time. I think this time they're really putting. I mean, there are some rumors and calculations saying like a close to 470 billion Chinese yuan, um, which was buying up Chinese shares when the government feels there's too much volatility and too negative of a sentiment, but they are very unlikely to buy Hong Kong shares or
Right.
US listed shares. There's also a little bit of nationalistic driven calculation here, right? Because
Yeah.
if it wants to support the market, it wants to support the domestic
Yeah.
market, even though it's just a fact. So you've shown really fact investing works well in Chinese A shares. And we talked to your researchers before, but help us, again, some of our listeners who may not be as versed in this area. Are you seeing something different or not different? And what is the multi-factor approach that you are using for China A shares?
Yeah. So well, I'm going to start, from kind of the multi-factor layer and then kind of work my way down. So when we think about uh, you know, factor investing or harvesting factor, you know, premia in a market, we think, there's a lot of behavioral related. So it's related to really retail individuals because of their own biases, the mistakes that they make. So it generates alpha opportunity for people who are more disciplined. And you simply take those behavioral strategies and make it systematic, right? And so you call that a factor, behavioral factor. And there are also factors that are just, hey, look, if you're participating in a market, taking on some risk, you're going to get a risk premium, right? So we think of harvesting these factor premium, right? So taking advantage of retail behaviors and really sort of taking on risk and being paid for it. In China, you got both in space, right? So this works in the U.S. and a lot of great managers use that approach to generate alpha. In China, when we tested this, unsurprisingly, the results are so much bigger, right? Because first of all, China is 85% retail traded. So if you're talking about harvesting retail behavioral mistakes as a alpha source, there's just a lot more of that to harvest in China, right? Where in the US, right, you're talking about 5% retail trading, maybe on a bad day when Robinhood goes crazy, it's 20%. But China is so systematically the sort of retail dominator. I call it, GameStop every day in China. So the behavioral factors work super well, not surprisingly. And there's a lot of anecdotes and great funny stories that I'll spare you this time. And then on the risk side, right? Again, it's a more volatile market, and there are more shocks, right? You got geopolitical shocks. You got just people overreact to information, right? It's a bit more fragile as a market, right? Liquidity come and go. And so if you're willing to also harvest factors that are associated with those risks, you also get paid over time, right? And this is why China generally pays a higher dividend, is cheaper because you're bearing risk. So people got to give you more return by letting you buy at a better price. So that's how I think about factor investing in China and the empirical evidence and then really kind of live performance that we ourselves have observed is such that the factor premium associated with things that we find in U.S. academic work are just much higher in China and much more pronounced.
So I think you guys are also using some of the public information, like the stock exchange, regularly disclose the kind of investors. I remember last time when we talked, like some stocks, how much is driven by small investors versus institutional investors. Um, can you illustrate a little bit, like aside from just the typical the balance sheet data from a typical accounting measures, like what other kind of strategies or data sources you guys are also using for your active strategy?
So in China, just the amount of data available and oftentimes available for free is enormous. Now they're shorter and they're oftentimes are more incomplete, uglier because the quant industry in China isn't as developed in terms of using these alternative data. And so not a lot of vendors out there cleaning data. So there's a lot more hard work to do, but that's great, right? Like, alpha is about barrier to entry, right? So if you can do the hard, dirty work and clean the data and interpret the data properly, you can get more alpha. Now, in terms of data, we're probably, I mean, we are probably the earliest quant manager to have entered China. We're actually invited by the two stock exchanges, the Shanghai and the Shenzhen, to go into China to work with stock exchanges to bring sort of quant investing to create smart beta indexes and then for China to then, launch smart beta ETF. So, we've been in there since 2009, partnering with the stock exchanges. And so we have been able to get data directly from them, and certainly research data because we partner in co-product development. And then we now sub-advise for the biggest ETF company in China, again, getting access to a lot of their internal data, actually a lot of, because they're owned by obviously one of the largest brokers, they have a big active practice, so we also get access to that data. So in some ways, we feel like we have an enormous advantage when it comes to, first of all, having great access to interesting data, but second of all, having partners who have exclusive data set that we can use.
Some of the data issue, I have to say recently, some China's data has become increasingly being restricted to people outside China, and some US data sets are also now being restricted accesses from China. So this is not to, blaming either side or something, just the geopolitical environment we are living in right now. Are you like materially being impacted? Or so far not yet.
So I would say not so much on the data side because, you know, what we access are not sort of sensitive data. We're like very, very far away from anyone who might look at the data we're accessing and say, ooh, that's related to national security, right? Because, it's like data you could buy. It's data actually in China, like the stock exchange makes that data available, right? Just sort of give you a little bit of an anecdote. Like the stock exchange in China, they see their job as sort of, you know, promoting more education, getting people to use more data in investing. So they actually try to push data out to investors and say, use this data, do analysis, right? Don't just, day trade based off of like random price movements. So, we're certainly operate in the realm where, the data, the exchange would say, yes, we want managers and people to have, access to that data. So you help the market with price discovery and create a more efficient market, right? So, we've only had fairly positive support from regulator and exchanges in terms of what we do to help with market quality. So I don't think at least at the frequency, the kind of data we use, that's ever been an issue. Now, where it's been a challenge, right? I would say the U.S. and China, I think of this as like, high school behavior, right? Like basically there's like a pissing fight going on, right? It's like, you do this to me, I'm going to do this to you. Like, we are a U.S. manager operating in China. So we operate under special license, and there's, a little bit more scrutiny, right? Because we're foreign managers. And I think there's some additional sensitivity, right? You never, want the regulator to somehow, because you are an American firm to give you sort of more restricted treatment and preventing you from normal marketing activity. So there, I think we are a bit more sensitive and aware about our activities there, and certainly vice versa, right? Because we have a China fund, and the regulators are constantly changing the rules about what you can invest in, what you can't invest in. So it just adds cost, and then it is what it is. I hope it
Yeah.
goes away.
Uh, well, I'm probably a little bit pessimistic. I feel like in my whole career, we are going to be living with this
I
because,
have the same fear.
every day, US and China is really in a kind of a competition, technology competition right now. And I feel like unless both sides feel so painful, they're just gonna, they're not gonna stop fighting. It's what I told my kids. I'm like, it's like unless somebody started crying or both started crying, I feel the fighting continues. In terms of China just recently finished two congressional sessions, which usually it's much more rubber stamping because most of the year's plan is already sent it out like in February. But March, formality wise, it has a congressional two sessions, and actually there are some information out of it. I think for a while I have been pretty talking about China's housing market is, not likely to have the kind of bailout that the U.S. Has experienced in 2009. I think the congressional session essentially just made it clear even more, like for people who are still, not buying the idea. I think again, these are macro factors. Do you pay close attention to China's political events, or since the strategy is much more bottom up driving, so it's not something which you actually put in the strategy?
Now, I mean, macro events are huge for us, and certainly huge when it comes to China. You know, we have a very data-driven approach, and now the way in which we use data model it is sort of very driven by our understanding of bottom up and top down, right? So what we realize in China is the factors that help us, select the stocks into the portfolio. These factors interact with a lot with the macro environment and macro variables. And so if you look at our active portfolio, right, and you measure our factor exposure over time, they do rotate and drift. And it's because we built the model to allow, sort of not fixed equal weighting of factors, but really allowing sort of dynamic rotation of the factors. And this is in the calibration particularly important and valuable in China. Just take, for example, right? I mean, you know, since the government has become much more interventionist and outright at the start of the year, they're just buying the stock market to create a support level, essentially giving you a free government put. Right? If you think of government put, that phrase became popular from kind of the U.S. Fed backing the market. So Beijing is doing kind of the same thing with its own stock market. And what you see is the factors that have become really, really powerful are what? Basically anything that's quality, anything that's sort of large cap value, because the government, right? Also, they're buying, but they're also afraid. It's like,
They are
I don't,
buying those ETFs.
yeah, I don't want to
Yeah.
buy and lose money, right? So what the government funds are buying, and because there's so much money, right? They can only buy the biggest company because those are the one that supports the market and matters for the index. They also want to buy high quality and cheaper, so there's sort of less risk, right? Because if you overpay, there's this higher risk. If you buy cheap, there's lower risk. So when they're investing, they're not just buying everything, right? They actually are also looking at sort of the safety factors, right? Large cap,
Yes.
quality, value. And so that's been the factors we rotated into, heavily driven by the political environment, the macro environment. And again, I would say the last month, right, much of the 10% performance for China Asia has come from those three factors exclusively.
Yeah, absolutely. So I know that yours is factor driven. We also have multi-factor strategies. Uh, how do you position sectors then in China? Because that's also extremely policy driven. So are you sector neutral or some kind of other approach to sectors?
We definitely have sector overweights and underweights. Now, again, we are quant, so the principle of quant investing, which says, hey, sector bets usually are not as high information as the single stock bets, and because there are fewer sectors, right, you can't diversify your bets as effectively. So, like, that's all part of our modeling. You understand, you know, you don't want to take large sector bets unless there's just a lot of information, from the model. But we do take them nonetheless because from time to time, right, you do pick up these momentum in a particular sector that has sort of government policy support tailwind, and that would become our overweight from the sector perspective. So, take for example, we got an overweight in manufacturing, and that in some cases, reflect what the model sort of picked up from, I would say, since last year, right? The big policy push saying, look, China probably cannot become the US, be sort of purely consumer driven, or purely finance driven, or purely internet platform driven, right? Like China is probably more likely to become a Germany, right? Very manufacturing driven, because that's what China has done. It's done well, right? So if it looks, can China be US or Germany? It looked more like Germany. So that policy has, really translated into a shift in sort of investments into the industry, the margin expansion. And so, the models picked up on that. We picked up an overweight there. We picked up an overweight into really kind of the pharmaceutical. We picked up an overweight into a lot of the consumer upgrade. And so, they become our overweight because the model is sort of understanding how the business and also some of the flow sentiment that's reacting to policy shifts.
Definitely. If even though the two sessions might not be, useful enough, but actually it just affirms this idea again in China. It has about six industries that the government heavily, and all are, I would say, by, new energy,
Semiconductor.
new semiconductor, biotech. Most of you can see, you can kind of test, like US recently is threatening to pass a law to making sure a lot of Chinese CROs, which are like a buyer kind of companies that does service for US pharmaceutical drug development, those companies are now going to have to, find Chinese market or market outside the US. So you can see that whichever US is putting in sanctions or restrictions is where China is investing heavily,
Oh,
because ultimately it's a technology competition between US and China is in a bit of a challenged situation. I think US definitely has an upper hand right now, because China used to rely on, for example, like semiconductor. China, I think 10 years ago, nobody would ever thought that, China couldn't buy it, like the semiconductor, the best chips. So I think now the regime, the mentality is definitely shifting in China, that it wants to develop technology, good enough technology, not
yeah.
as good as the US, but good enough that China's companies can still, but it is a big challenge, because to do your own investment costs money, right?
Yeah.
So, I also noticed that you have extended factor investing into developed markets as well in one of your strategies. What makes you like because we also have, worked in multi-factor and would like, to really, want to be the, the the good ones, to try to make the best multi-factor. What's your investment process, and how is your approach? Maybe they're slightly different from some existing factor investing in developed markets.
Yeah, Liqian. So, like our research and our product development actually works in the opposite direction because, I obviously came out of, research affiliates. Our firm spun out of research affiliates, and we were very well known in terms of, U.S. multi-factor, developed market multi-factor. That was kind of the bulk of the book for research affiliates. And so clearly that's kind of my research DNA. My team, we started the research by looking at, look, what are all the factors that work globally? Well, it used to work. What has stopped working? Why has it stopped working? Is it cyclical or come back? Right? Value underperform. Is it because it's dead, or like value is this big cycle? So most of our research actually start with global data set, the developed market experience, and then say, well, what can that tell us about emerging markets? What can emerging market then tell us more specifically about China? And from a product perspective, we started China not because that's where we started research. The researchers have always been global because global tells you so much more about everything else, right? Because if you think about it, right, if you look at the global basket, there was a point in time when Japan was emerging, right? It wasn't always developed, right? And if you look at
Yes.
the part of Japan where it was all retail, where its per capita GDP was only 12,000 US, well, that part of Japan tells you a lot more about China than China from 12 years ago when its per capita GDP was only 3,000, right? So we always done research using global to help us understand the world, the future, the trend line for emerging market. And then from emerging market, you look at Taiwan, you look at South Korea, and that probably tells you a lot about where China is going, right? So, we kind of have always done the global research. The product launch started with China because the alpha was the biggest in China. And in some ways, the beta 5 years ago felt like that has an opportunity. Clearly because of the research, also have a global product. And the global product, when we line up the alpha, our alpha for EM in China have been the biggest, and it's unsurprising, right? Because that matches the research. And our alpha from the multi-factor harvesting for global is probably a third of that. And again, unsurprising, but there's an alpha there, right? Because the factor premium harvesting theory is true. Now, the way I think we do it that's different is, I used to have the more MBA textbook approach, which is like, hey, these are the 5 factors that is in every CFA and every MBA textbooks. Let's start there. And I think that's the right place to start, right? You minimize educational costs, right? But I think the market's probably ready to go to multi-factor 2.0, right? Where they can say, okay, well, there, probably a lot more factors. And many of these factors are trying to give you the same information, but it's probably better to use 5 different factors to help you get at what is cheap, right? What is value, right? Instead of just using the Fama French, a price to book. Price to dividend has information, just slightly different, right? You just add in different dimensions. And so we do that for the different factors. So even though it looks like we got 200 factors, but they all really come back down to about 11, 12 major categories of information, sentiment, valuation level, risk. And so, that's our approach. And of course, when you have too many factors, right, just for sort of, how do you combine that into a portfolio? You want to bring in more statistical power. And I think that's where kind of advances in machine learning, advances in better statistics to help you really avoid data mining in the backtest. Those we've sort of brought on board 5 years ago. And, the desire is not we can find more alpha, but the desire is given the increasing complexity of data we use, the factor we use, how do we make sure we sort of detrend and reduce the backtest to not fall prey to data mining?
That's great. Yeah, we definitely is also trying to, for example, right now in our multi-factor strategies, we actually have not incorporated growth because growth is a really difficult factor to incorporate in the multi-factor space, even though, a lot of tech is all growth, as a single factor is popular. People use it for tactical trading, but as a one of the multi-factor is actually not that easy to incorporate into the framework. So definitely you're right. Like many of us in this industry are trying to move away, move into the multi-factor 2.0. So I think one question I sometimes I have to say, like from my experience, even though I myself, believe in multi-factor, sometimes it's really difficult to convince people. Like people just like they like single factors. If you just tell them value, quality, but as soon as you put in multi-factor, they were like, oh, this is, too much for me. Do you like in your situation, like, do you feel this similar sentiment? Sorry.
Yeah, when we're out there talking with advisors, we have exactly Liqian, as the same experience as you do. And that's when we realize, right? There are really two sets of buyers, right? There are people who say, look, for me, ETF or how I allocate is more beta, right? And so in that case, don't give me anything complex because I want to know exactly what I'm allocating to. I want to know exactly what I'm betting on, right? So in that case, hey, you say, look, I'm giving you a value uh, portfolio. And so when you're betting on this, it means you're a contrarian. You only care about cash flow, cheapness. You don't care about growth. And so, there are people like that. Once you add more factors, you're really now speaking to people who say, like, like I don't have a strong view about this. Maybe I've got a view about China, but beyond that, I don't have a strong view about, you know, aspects of China, right? Like, do I want more tech, more growth? Do I believe in big dividend plays from a state enterprise? So they kind of go, that's you, right? You as a manager should figure that out and do it well for me, either in a diversified way or maybe in a tactical way with rotation. So, Liqian, I think, like, you probably have to just decide, like, look, our process is complex enough, so we'll tell you about the process, but this is active, and so hopefully you believe in our process and believe in the numbers, and then you don't have to go and explain all the factors to them and then what you're doing in the portfolio construction. Or you kind of have the passive. Look, I'm going to give you value because you believe in that, and that's it. Right? I'm not going to do anything else more complicated. So I think,
Great.
yeah.
Yeah. No, I agree. I think sometimes client, you just have to, repeat it again and again, and they generally get it in the end. Um, uh, Finally, I noticed you've posted frequently on LinkedIn. Is that the main outlet people can get the best investment thoughts and things for you and your company?
So I would say I'm super active on LinkedIn. My company is slightly less so. So if you want to interact with me in a idiosyncratic and whimsical way, LinkedIn is a great place. I don't use X. I think some managers use X more. So you can just direct message me on LinkedIn, and I'll generally reply to you. Or you can just follow me on LinkedIn, and serious research on there, random commentaries on there. Short video when I'm in Japan, eating sushi will be posted. Uh, Now, of course, once you find me, we can sign you up to our research distribution. So you'll get an email blast from us when we have like a full research piece talking about an asset class or strategy. So that's probably the best way to sort of engage me. So, start with LinkedIn, and from there, I can point you to the right resources.
That's great. I'm a little bit more active on Twitter. I think mainly because my boss Jeremy, he started on Twitter, so then we are all in there. But I do see some of our friends are much more active on LinkedIn, and I have to say I just don't have any extra bandwidth on my life to to post on another. Sometimes I occasionally also post on LinkedIn as well. But yeah, it's a different approach, but ultimate goal is the same. Try to explain to the things we kind of believe in to our clients better. Thank you so much.
Thanks, Lee Chen. And maybe next time we can do a TikTok video. That's another
Yeah,
channel.
yeah, yeah. If it's not banned.